Hey guys, Jack here. So you want to invest in growth companies, but you don't really want to pick out individual stocks. I mean, why would you? You're going to have to retest the stocks, making sure the stock is the right price for you at that moment, and there's a whole load of things in between, and you could be wrong in the end as well. Although with individual stock picking there's potentially more money to be made, it's certainly more risky. ETFs are a great way to reduce your risk because you're diversifying your pound investment across multiple different growth companies. In this video, we're going to be covering my top 4 growth ETFs for you to invest with a hands-off approach. Now, none of what I'm about to say is financial advice, but I'm going to give you an overview of what each fund is, what the risks are with each fund, and my general opinions about the fund. Also going to be touching base on what are the historical returns behind each fund. We'll start off by talking about one of the most popular funds in the UK, which is the Ishares Clean Energy ETF. By investing in this ETF, you're tracking the performance of the top 30 global clean energy companies. The fees of the fund are 0.65%, whilst the dividend is 0.59%. Now, this is a great fund for those who want exposure into the renewable energy market. Guys, we're talking solar, wind, and other renewable energy sources. If we look at the perspective of March 31, 2021, in a year it has given a return of 151%. But in a 10-year period, it has only gone up 5%. That's because when the fund was brought into the market, it was severely overvalued. In fact, if you had bought the fund at the inception date, you might be still sitting at a small loss or a break even. Guys, the clean energy sector is very controversial. Not because nobody wants to see wind power and solar power take over the world. It's because of the world's dependencies on oil. Although there are many government programs that are designed to increase the usage of clean energy, renewable energy, the penetration into the market is very low. Oil is still the most cheap and the most reliable energy sources the world has. So there is a debate going on whether it's too early to invest in this sector. Guys, I think in the short term there are some risks. In the long term, however, as there is more utility grade battery storage units in the market, I think the clean energy sector will be more in use. By in use, I'm saying used by the masses, and that's when the real switch will happen. The next growth ETF is the Arc Invest Innovation Etf. Now, this fund is really popular and it's pushed by Cathie Wood, who is the fund manager. It's quite diversified with 57 technology/innovation companies. The fund's highest weighting is Tesla with 11%. If we look at the performance, it has gone up 122% across last year. This is in comparison to just 45% of the S&P 500's reinvested return. Now, it's safe to say, the guys, that this fund and Cathie Wood have become a market maker. It seems so that if Cathie Wood comes into the media and says, X company is good and I'm going to put money into it, then the company's share price just goes bonkers beyond belief. So there are a lot of overvalued companies in this list. So how do you invest in this fund in the UK? Well, you sort of can't. Well, kind of. Due to some extra paperwork being required by the UK authorities, this fund is not actually available. I don't know why the fund manager isn't actually publish those papers, because then it would open the fund up to a wider market. However, there is a way to invest in this fund in a sort of workaround way. If you hop onto Trading 212 and you go into the investment pie section, there is a pie there which aims to emulate this fund directly. Now, the good thing about this pie is that the author does want to update this pie on a weekly basis, but it does sort of fall into the limitations of Trading 2 investment pies, where you're going to have to be notified to actually make the changes to the pie. So not only would you have to wait for the author of the pie to copy Cathie Wood's in terms of the real Arc Innovation ETF, but you would have to also face delays between the author sending the next update out and then you copying the pie. This means that your simulation of the pie is not exactly synced with Cathie Wood's. Besides, this pie only features 42 companies, whereas Cathie Wood's Real Innovation ETF has 52. This is obviously because Trading 212 does not have the full list of stock. Although I do think the majority of the stocks are on here, so I do think it's a good option for those who want to invest in emerging companies, but also emerging sectors. The next ETF we have is the iShares Information Technology S&P 500 ETF. This fund takes out and invests in some of the companies that are in the information technology sector in the wider S&P 500 fund. These companies are arguably more established than the ones featured in Arc Innovation ETF. So you might see less volatility because they're higher market cap, and it takes a lot to push the needle. However, since they're in this tech sector, you're still exposed to the volatility that comes with that. So you got the likes of the big players, Microsoft, Intel, PayPal, Nvidia, and a couple of others. And if we look at the performance, it has done really well. Over the past 5 years, it has given a return of 267% in comparison to the S&P 500 only returning around 100%. And it does make sense. Tech companies have huge growth and scale potential because they're not having to fork out massive amounts when they're acquiring a new user. This means that they can scale at a much faster rate than traditional companies. And now, even if you invest in the S&P 500 directly, half of the funds weighing is directly in tech companies. So you could even argue that most of the returns are coming from the tech sector anyway. Although most of the funds weighing is actually in Microsoft and Apple, I do think there is solid growth potential in this fund as it has a lot of good companies with great outlooks in the future. Now next, let's dive into EQQQ by Invesco. This fund tracks the Nasdaq 100 index with a primary focus in the tech sector. I personally love this fund because it's less focused on aggressive growth because it does focus on established companies. Return-wise, it has gone up 217% across the last 5 years. Now, the real problem you're going to get with investing in such funds is the values of the companies you're investing in the back end. The valuations are extremely high. In the tech sector especially, the valuations go well beyond the company's earnings. So who's to say the valuation bubble, or whatever you want to call it, isn't going to pop tomorrow and these companies are going to come hammering down. So these ETFs are not a replacement for something like the all-world ETF, which gives you a diversified exposure across several sectors, across several markets. Which swiftly brings me to the pros and cons of growth ETFs. Growth ETFs are great in a bull market. You're going to be seeing high returns, as we have seen historically speaking. However, it's good for those who have a long investment horizon. As growth companies are more risky, those with a large investment horizon can actually just ride out the storms as they come. However, if you're getting more close to your investment horizon and you want to actually get some income from your fund, then this ETF or these ETFs are not good for you at all. As growth companies are expanding and they're wanting to reinvest some of their money, they're not going to be paying out a dividend, not a huge lot anyway. Also, growth ETFs are hugely volatile. So if you're wanting to sell some of your shares for a regular income, then that sort of can be impacted as well. So it's important for you to get a good balance between dividend paying stable companies and those in the growth category. If you do want to check out my top dividend paying ETFs, then make sure you check out my video here. Otherwise, make sure you like and subscribe, and I'll see you in the next video. Thank you so much for watching.